Sun TV has underperformed both the CNX Nifty and CNX Media, but we expect this trend to change going forward. The largest business interests of Sun TV lie in the TV broadcasting industry, with over 33 channels. Minor business interests include radio broadcasting as well as movie production and distribution. Recently, Sun TV had bought the Hyderabad franchisee for IPL. Sun TV also has a global presence with customers in over 27 countries. We assign a buy recommendation to the firm, to the stock. The biggest three factors are the industry growth, which is driven by digitization, the competitive advantage that Sun TV has, as well as the attractive valuation. The only piece that does not fit the puzzle is the corporate and political risk, corporate governance and the political risk. Now we'll go over each of these drivers one by one.
We start with the industry growth of the media and entertainment industry. This is an 821 billion industry which is dominated by the television segment in which Sun TV primarily operates. The television segment derives its revenue from advertisement as well as subscription, and we see that ad revenues are expected to rise at a CAGR of 14% over 2012 to 2017. This bodes well for the company as well as for the broadcasting industry as a whole. The second growth driver of the television segment is the subscription revenue. We see subscription volumes expected to increase tremendously over the next few years. This is driven by the India growth story with the increase in working population, expansion of the middle class income, etc., which would drive both an increase in television households as well as increase the penetration in these television households, thus driving the subscription growth. A recent trend in the industry is digitization. This has been mandated by TRAI recently. We see that India has a lot of scope for digitization, as even developing countries like Indonesia and Sri Lanka have much higher digitization levels than India. Now that TRAI has introduced digitization in the country, we expect digitization to increase substantially, which would help to increase both advertisement and subscription revenues for broadcasters because of target-based advertising, as well as helping them to develop niche subscriber bases in the industry. Digitization would also lead to an increase in ARPU because of a transparent subscriber base, and we see that broadcasters would witness a substantial increase in the ratio of their subscription revenues. ARPU would also increase because of availability of premium channels such as HD, as well as availability of customized channel packages for subscribers. To sum this up, we see that there's an increase in subscription revenue as well as advertisement revenue, which would lead to an overall CAGR of 18% for the television segment. However, there are some concerns such as the ad minute cap and the recent increase in licensing which has been introduced by TRAI, but we expect the broadcasting industry to overcome all this through the high CAGR which they are expecting. We now proceed to the next driver.
Now moving on to the competitive advantage which Sun TV has within the industry. As this figure shows, Sun TV has presence across almost all genres of TV channels, and hence with the increasing trend of viewer fragmentation, its subscription revenues are expected to increase in the coming time. Also, Sun TV is the largest regional player in the country, and this segment, as can be seen, comprises about 27% of the total viewership in the industry. In the recent times, it has been seen that the ad revenue growth for the regional players has been much higher compared to the national market, and this trend is expected to continue in the coming times. Hence, Sun TV is expected to benefit more than the national players. Also, we conducted some primary research and we found that the popularity of Sun TV's content has not decreased, but people expect that Sun TV would face stiff competition from the new entrants in the coming times. Now, as was mentioned earlier, digitization would lead to a substantial increase in the subscription revenues. Now, as this figure shows, the digital to analog subscribers ratio is much lower in the southern cities right now. So, since these are the areas where Sun TV has the maximum presence, hence digitization would benefit Sun TV much more than the other competitors. Digitization would also lead to a reduction in the carriage charges in the industry because it will lead to an elimination of the artificial scarcity which was caused by the analog infrastructure. Now, this would benefit regional players more than the national players, as it would make it more economical for them to enter other states. Sun TV would also be able to enter target areas where its audience concentration has been low. So all these factors summing up would provide Sun TV a strong competitive advantage over the others. Now moving on to the next driver.
So the third key driver we have is the strong financials that Sun TV has and its attractive valuation. So to look at the financials, we compared it with its closest competitor due to lack of other possible comparables, which is Zee TV. What we see is Sun TV has a very strong and stable profit margin. It has a shorter cash conversion cycle. It has pretty strong cash flow generation capabilities, and it has a very stable earnings per share over the years, which if we compare with Zee, it has been quite volatile over the last few years. Another important thing over here is Sun TV has zero debt on its balance sheet, so it does not have any interest payment liabilities. Now coming on to our valuation, we did a DCF valuation, which was our primary model. We forecasted the subscription and ad revenue as these comprise nearly 90% of the total top line. For the subscription revenue, we did a bottom-up analysis of the DTH and the cable business. For the ad revenue, we did a top-down analysis. In terms of the capital structure, we believe that Sun TV will have a stable capital structure over the forecast period, and hence its WACC would remain constant at about 12.33%. Based on these forecasts, we arrived at a DCF value of 431 rupees per share for the Sun TV stock. Now this excludes the IPL business. For the IPL business, given its uncertainty, we decided to do an option valuation. So we did a binomial option pricing for the IPL business, where we assumed that the business will turn profitable from FY 15-16 onwards. And based on our estimates of the option pricing parameters, we arrive at a value of 5 rupees per share for the Sun TV stock. Now to validate the DCF valuation, we did a few other valuations. We did the residual income valuation as it assigns lesser weightage to the terminal cash flow and more weightage to the initial book value. As Sun TV has had a stable dividend payout over the last 4 years, we also did the DDM analysis, and we also did a comparable analysis by comparing its PE ratio with Zee. Based on these, we arrived at a valuation price range of 410 to 460 for the Sun TV business. Now we did a sensitivity analysis for various factors to see how sensitive they are. What we see is that the ad revenue growth rates and the possible market share erosion is not very sensitive for Sun TV, but what we see is the WACC and the terminal growth rate are very sensitive to the estimates. So we did a Monte Carlo simulation, the results of which show that even at a 35 percentile level, the stock is still a buy, which is an upside of 15%. Hence we believe that the stock is valued very attractively and we are giving it a buy recommendation. Now we move on to the last part of the story.
Going forward, we believe that corporate governance and political risks is one factor which does not fit into the entire puzzle. So when you look at this, the corporate governance issues which the company has are, one is that the promoters are one of the top paid executives in the country, where their compensation is 86 times to that of other executive directors, plus their compensation is 10 times the closest peer in the industry. Also, the company has a history of frequent buying and selling of aircrafts, and there are 3 instances in the past 5 years for a non-core business, which we think doesn't make sense. For the political and legal risk, we think that they are very high with this company, considering the fact that the promoter family is affiliated to a strong regional party, and they are being promoted for their alleged involvement in the 2G scam. Also, the company has contingent liabilities of the order of 2.6 billion, which is related to income tax and customs duty. So, related to all this, we think that the political and legal risks are pretty high for this company. Also, we see that in the past 3 to 4 years, we had several instances when the stock has declined more than 10% in a year because of political as well as legal risks associated with the company. Looking at the investment risks the company has, we have divided the risks in a matrix of 2 by 2, depending on impact as well as probability. So we see that the high impact risks are promoters' legal risk as well as operational risk. The company has other risks such as hike in ad rates, increased level of competition, industry consolidation, digitization delays, macroeconomic slowdown, regulatory risks, threat from substitutes such as IPTV, decline in Sun TV's popularity, and contingent liabilities. However, the good part is that there is no risk in the top right corner, which is a high impact, high probability.
Okay. What's changed for this company in the last 3 to 4 years? The one most significant change which you would say has happened for this company in the last 3 to 4 years?
I think what's happening is that the industry dynamics are changing in the last 3 to 4 years. So we wouldn't say that the company's per se strategy has changed much, but because the industry dynamics are changing in terms of digitization and cash subscriptions, as well as introduction of new channels, etc. There's genre-based channels, there is target advertising. All this has led to a lot of changes in the industry vis-a-vis the company. So now the company is also exposed to all these factors, and there is a changing dynamic in the industry which is affecting the company.
In terms of evaluation methodology, why have we chosen DCF as the segment?
So the reason why we chose DCF is because over the coming few years, we believe that the revenue is going to be a bit, the growth rate is going to be pretty high compared to the average growth rate that it has experienced over the years. And that's why we felt that the free cash flow would be better estimated if we look at a DCF model. If you look at other models like DDM, it would not capture the things like the digitization that is coming into effect in the industry, as well as the ad revenue growth that is happening. Because we assume above average digitization growth, digitization-led growth over the next 4 years. And that is why we feel that it is better to do a detailed examination of the free cash flow for the company over the next 4 years, after which it will stabilize and return to a more constant growth rate.
Okay, thank you.
Can we go to the share price chart? You showed us the share price chart with the long-term share price history. There was one where you mentioned specific events. I think that it was a political risk chart. You were showing specific events. Just let's go to that. That's it. Yeah. Come on. So just to echo Harish's question again, have a look there and tell us what's changed in the last 3 to 4 years.
So one of the thing is the promoters have come under the legal scanner. So that is a key risk for the stock going forward. So as you can see over here, there have been more than 10% falls in a single day based on merely legal or political events. So the legal association is one thing which we believe has a significant impact.
To add, there has been the 2G scam which has taken place. There has been changes in the Tamil Nadu government. These have also affected the company.
So how can you reflect that in your valuation? You used a DCF. How do you reflect that in your valuation?
So one of the things that we noted that it is actually already captured in the higher beta that the company has. So when we look at other players in the industry like ZTV, it has a beta of close to 0.6. Compared to that, Sun TV has a beta of 0.96. And the average industry beta as well is on the lower side, around 0.6. So we believe a part of the risk is captured there itself. Even if you look at the PE multiples at which the company trades, it trades almost at a discount of 30% to the industry PE. So we believe that a lot of risk is captured within the pricing itself, but we do understand that there are one-off risks, one-off events where the stock might witness a significant fall within a day, and not all of it is actually captured in the model.
Okay, can I just see the cost of equity calculation? There was a slide there. So you got a cost of equity of 12.3%. Now, if I were to tell you that the 10-year SBI bond, one of the most riskless investments you can get, the 10-year State Bank of India bond, gives me roughly 11.5% return. Do you really think 12.3% is the sensible cost of equity for Sun TV?
We do believe so, because as we said, the industry in general has a pretty low beta. As we said, the average industry beta is about 0.6. So it does have a pretty low level of risk, but compared to that, as we can see that the risk-free rate is about 8.6% and the market rate of return is close to 12.5%. Based on that, if Sun TV has a beta of close to 1, we do believe that 12.33 is a fair assumption for the WACC for the company.
What is the key risk in this kind of a business, according to you? And how do you assess that?
One of the key risks.
One key, single most important factor.
The biggest risk we think the industry faces is from the advertisers. And, we say this because advertising constitutes more than 50% of the revenues, and especially with the TRAI ad cap coming in, we think advertising revenue per se constitutes a big part and a big risk as well, because if it were to go down, it will hit the top line as well as the bottom line.
Just to add to that, the reason why we say that is because the recent trial limits that were enforced have already started reflecting negatively on the top line of the company. The Q2 numbers came out for Sun TV and the ad revenues actually went down by about 4% in Q2. While the management has taken certain steps to rectify that, we do believe that the ad limit is a key risk going forward in this business.
One other point, the media and entertainment industry is also seeing some nascent industries such as gaming and internet media. There is a lot of focus on these as a mode of advertisement for FMCG companies and other companies. So there may be a diversion from television advertisement to advertisement in other segments, and that would impact broadcasters.
But what is the key driver for the advertising revenue?
The global outlook and the country outlook of the economy as a whole, how much companies are spending on advertisements and how is the
I
expansion
mean,
industry
all those
expansion.
other things being equal, okay, what else could drive the advertising revenues? Go up or down?
Sun TV has 50% of its advertising revenues coming in from FMCG companies, and around say 40% from regional consumer products companies, and the rest is from auto and other industries. So we think that the growth of these industries is very important when we look at advertising growth rate of the company itself, and that is a very big factor.
Another thing is Sun TV enjoys a monopoly in the southern regions. So in these areas, like compared to its competitors, Sun TV can charge higher rates from the FMCG companies, since it's a monopoly.
Yeah, thank you.
So folks, you said you understand competitive advantage and you try to capture it. So just help us understand in a few sentences, what is the core driver of competitive advantage for a TV broadcasting company? Just think about it and tell us what is the core driver of competitive advantage for a TV broadcasting company.
So for broadcasters as a whole, it would be a loyal customer base in terms of them having their their viewership and their ratings being high. In terms of Sun TV, the core advantage would be its regional presence rather than national presence.
So how does a broadcaster get a loyal viewership base? How does one build that?
So that would be mainly driven by content.
So why is it that certain broadcasters have more compelling content than others?
So there is, for instance, right now there is a trend of reality shows, etc. So the preference of consumers keeps changing. So they have to continuously keep revamping their content based on the tastes of the consumers. At the same time, so we'd like to reiterate that we did a survey of Sun TV's content, and we found it to be a very favorable. We found it very favorable.
I'm not disagreeing, but Star is also trying to produce great content. Sony is trying to produce great content. How come Sun dominates the content stakes and the viewership stakes in quite this manner?
The current viewership would also have an influence, because if you see the current size of your viewership is large, then automatically the people who are making good content, they would come to your channel to broadcast their serials on your channel. So that would be another major factor.
So Sun TV also has not a first mover advantage, but somewhat a first mover advantage. Zee and Star are entering the regional markets now, whereas Sun TV has been present since a long span of time. So obviously there is continued viewership of the same programs, which leads to customer loyalty for Sun TV.
Thank you.
Thank you.
Good evening. We are Team Francis Parker UK, and we are here to present our investment research on Zee Entertainment Enterprises. We have given a buy rating with a target price of 311 rupees and an upside potential of 12%. Before going into the research, let me first introduce you the company. Zee is one of India's largest television broadcasters with a diverse channel portfolio, both in terms of language and genre. One of the major cost elements for Zee is the programming cost, which drives the top line elements, advertisement growth and subscription revenue. Over the past, Zee has proved to be a very stable and healthy company, both in terms of EBITDA, earnings growth and PAT, which has grown at 15 and 14% respectively in the past 5 years. Now, what factors make Zee a buy? What is the research which went into it? We will be presenting our investment thesis in 5 parts. Starting with the macro analysis, we go to industry specific and Zee specific analysis, followed by valuation and risk analysis. In the macro factors, the first would be the low TV penetration levels in India. Currently, it is at 60% levels and is expected to go to 70% level by 2016. Also, there is a trend of increasing personal disposable income, which is expected to increase at a faster rate than what has been witnessed before. So these factors, we believe, will directly contribute to the top line of a television sector companies. Going to industry-specific factors, the single biggest factor which is going to impact the television media is going to be digitalization. Digitalization proposes to remove the underreporting of revenues which is done by LCOs by converting the analog subscribers to digital subscribers. But why do we believe in digitalization so much? What are the factors which make us believe in digitalization so much? That is, let us present you in three parts. Starting with the successful implementation of phase 1 and phase 2 digitalization, which has resulted in seeding of 25 million set-top boxes across Indian households. Second is the intent shown by MSOs. MSOs, being a very important link in the value chain of television media sector, has shown a lot of intent in terms of money and also time in phase 1 and phase 2. Also is the drive from TRAI, which has a watchful eye over all the components and ensuring smooth implementation of phase 1 and phase 2 digitalization. Because digitalization becoming so important, we decided to quantify the amount of impact digitalization can have on subscription revenue. We came up with a model which suggested to us that subscription revenue as a percentage of total revenue is expected to increase from 43% to 48% by FY18. Now, this is a very important aspect because subscription revenue represents sticky revenue. So this is a very good aspect for Zee. Continuing on further industry-specific factors, I invite Shyam.
Thanks, Prakash. Let's discuss about some more growth drivers of the sector. The E&M sector over the years has grown at a significant rate, and TV having a significant pie of it. The TV revenues are projected to increase at a CAGR of close to 18% for the next 5 years, and the Zee's share of the TV's revenue has increased considerably over the past few years. So thus, we expect that as the sector grows, Zee is also expected to grow. Recently, there is a shift in the rating mechanism from CPRP to CPD system. CPRP is based on GRP and is a relative measure, while CPD is based on absolute numbers. It is currently backed by the broadcasters, as they believe that those broadcasters with higher market share will have a positive impact on their advertisement revenue. According to FICCI KPMG, the HD panels are expected to grow at a CAGR of close to 35% for the next 5 years. This will increase the ARPUs of the sector and will have a positive impact on the subscription revenue of this O&M sector. Moving on, we also analyze the FMCG ad spending. But why? FMCG contributes close to 50 to 55% of the ad revenues of the total E&M sector. We expect this trend to continue mainly because of this industry is highly competitive, and we expect because of this competition, the advertisement spends to increase. There has been instances in the past when P&G came up with new oral care product, the Oral-B, and also the stiff competition between the Tide and Rin has increased the advertisement spend of the FMCG companies. Also, the slackening volume growth implies that FMCG companies are expected to increase their advertising spend to maintain their volume margins. Also, the increasing FMCG penetration in the rural market, increasing TV penetration, is expected to increase FMCG ad spends and will have a positive impact on the advertisement revenue of the E&M sector. To discuss about the Zee-specific factors, let me call upon Gunaseelan.
Thank you, Shyam. Having thoroughly analyzed the financials of the firm, we found that the company has strong liquidity position, healthy returns, robust margins, and sturdy cash flows. Also, Zee is a near zero debt company, which implies the company has strong performance backed by healthy financials. Zee also exerts significant dominance in most of the regional market it operates in, which gives a fillip to their advertisement revenue. Also, recently, the flagship channel of the firm, Zee TV, has been gaining traction, implied by its improvement from the 3rd position to the 2nd position in the Hindi GEC segment. This again gives a significant commanding position for the firm. Zee has recently adopted a global expansion strategy as implied by their corporate positioning, Vasudhaiva Kudumbakam, which is